Hey guys, welcome back to the channel. Today I'm going to be going over a highly requested topic for my channel, how I decide what a stock is actually worth, my process, what's the growth, what's the value, how do I know if a company is justified, my whole process with that, my whole fundamental framework through that. So without further ado, let's go ahead, jump in here. But before I do anything, before I value a stock, I'm valuing an actual business. You got to remember, there's a business behind the actual stock price. You might see stock price going up, going down each day, but you got to remember there's a business behind that. So there's three things I look at. How fast can it grow? Is this a company that's going to be accelerating growth? Are more people going to be buying it? More people going to be using it? How profitable can it be? Is this a business that I think can bring margins up? Are they going to be more profitable in the future? And how durable is the growth? If I look 3, 5 years into the future, do I think they're still going to have incredible growth? Are they still going to be relevant? Is this an actual company? So what are they going to be in the future? But you also have to remember, great companies does not mean it's a great investment at any price. So just because you have an Amazon, a Meta, Magnificent Seven, amazing companies, does not mean they're incredible prices. Doesn't mean you're going to get a great return. They could be, maybe they do, but looking at the fundamentals, you have to know how to actually value them. So next up here, focusing on the fundamentals. First off, I do not start with the stock price. I've seen a lot of mistakes out there of people just going and being like, oh, this stock's $15 per share. It's cheap, let's go buy it. Or it's $500 per share. That's really expensive, I don't want to touch it. The share price is really irrelevant, in my opinion. I don't even look at that first. It does not matter. What are the numbers I'm actually looking at? Well, what's the growth? What's the net income growth in the future? What's the revenue growth? What's the earnings per share growth? These are the numbers I believe that should be focused on first before you even think about the stock price. I need to know what a business can earn before I decide what it's worth. So, value of growth. Not all growth is valued the same. If you have an incredible high growth rate runway into the future, you're going to be given a higher value. That's just the math behind it. That's just what happens. You're going to command a higher PE ratio, which we'll get into. The value of a stock comes down to two things, in my opinion. First, the future EPS, what they're growing into the future, and the future PE ratio, price to earnings. Those two multiplied together equal your future stock price. This is just the basic math behind it. And you don't even need future here. If you just look at what's the EPS this year, what's the PE ratio this year, if you multiply those together, that's just what the stock price is. So, just a basic example here. If you have an EPS of $1 for the year, if your PE ratio is 20, you multiply those together, that's what the actual stock price is. And what we can do is run those numbers into the future, what we think is going to happen, or a high probability of what's going to happen, to see what the actual value is. So I'm trying to estimate what those two numbers are, what the EPS is growing into the future, and then what's a respectable PE ratio for that growth into the future. So getting into the real meat of this. This is my valuation software I use, and I'm just going to run through a quick how-to of this. Feel free, you guys, run your own numbers. You guys can do this on your own, but this just helps me plan it out into the future, makes it more convenient. So, starting here at the top, this is Celsius, a drink company. Their current stock price is around 28 per share. My base year is 2026, so full year of this year, 2026. This is what the high likelihood their numbers will be full year this year. 2026. So I plug in their revenue, their net income, what their expected base EPS is. And then what I do with that is think, what is their expected revenue growth and net income growth 3 to 5 years into the future? I go online, I find analysts, what are they thinking into the future? And then what do I think? And kind of compare them, figure out what do I think a good base case is for an average growth rate over the next 3 to 5 years. So right now I have 8% revenue growth, 14% net income. Now what I do, this is very important, the basic EPS drops right down here to base year 2026. And I take the net income growth, I have it right down here, and you multiply it each year out 4 years into the future. So take the 161 times 1.14, 14%, do it again and again and again out to 2030. So if they grow net income 14% per year, this is what their EPS will be in 2030. And you might be thinking, Eden, this is net income growth up here. This is EPS down here. That's two different things. Yes and no, net income and EPS grow basically the same amount per year unless you have either share dilution, company puts out more shares to add more capital, more cash for them, or buying back shares, taking shares off the market, and basically you'll have less share count, so EPS will be higher, which is better. So that's just basic rundown there. Those are usually the same. I will maybe adjust my base case, what I'm thinking the CAGR is, based on what the company's doing, but they're roughly the same. Many times they are the same. So 14% net income expected per year the next 5 years. I go ahead, apply that to EPS each year, get to 272 in 2030. So that is the number I'm projecting EPS in 2030. So I bring that up to my base case for 2030. You can see the 14% net income here for base case. Now, PE ratio. This is price to earnings. And remember, what did we learn previously? EPS times PE ratio is stock price. So what is a respectable PE ratio for a drink company, an energy drink company with great growth into the future, growing net income 14%? This is something that you learn the more you're in the market, the more you see growth, the more you see growth with a PE. But basically, higher growth, higher PE. Sectors trade at different kinds of PE. If you look at banking, they trade a little lower PE. If you look at SaaS and its history, it's usually a higher PE. So you'll learn this over time. Basic way to think about this, average company in the stock market trades at a 20 PE. They usually have 6-8% net income growth. This is a higher net income growth, so it'll have a little bit of a premium. Hopefully that makes sense. If it didn't, you can always go back, but I think a 25 PE is respectable given the 14% net income growth. So you times the PE ratio by this expected EPS into the future 2030. That gives you the current stock price in 2030 of around $28 per share. And that means you would get a 25% CAGR given all that plays out. CAGR is just the average return per year, average growth rate of the stock per year. And then you go ahead, run your bear case, your bull case. What if the company just fails, doesn't do well, only has 8% net income? It'll have a little lower PE, lower growth, lower PE. You get around a 9% CAGR. What if it's a little higher? Go ahead, plug that in, a little higher PE. This is how I run my numbers and determine, do I think this is a good opportunity? Do I want to actually buy this stock? So if that made sense, if it didn't, you can always go back, watch it again, but this is how I go ahead, run my numbers, and figure out what's a good CAGR for this company in the future. But how do I make a final decision here? Because every company is going to be different. There's going to be different base case returns. Maybe the bear case is going to be extreme. How do I go about making a decision? Does the return justify the risk I'm taking in the company? Well, firstly here, I need my expected return to be greater than my required return. My required return is around 20%. So if my base case is not at least 20%, I'm not even interested. Secondly, how likely are my assumptions to be right? Maybe it's a crazy growth company, crazy valuation. Maybe my assumptions may not be right. Maybe there's a higher probability of a bear case going into effect. That's something I'm always thinking about when running my numbers. Are there better opportunities in the market? This is a big one. Maybe a company has 22% CAGR, but there's another company that would look better in my portfolio, give me more diversification, that has 25% CAGR. So what's the greatest opportunity? Because there's all these stocks in the market. A bunch want your money. Some have great returns, some have good returns, some have bad returns. All these companies want your money in the market, but everyone has a limited amount of money. Doesn't matter who you are. So you got to determine what's the greatest opportunity for you. And ending it here with KISS. This is Keep It Simple, Stupid. This is by Kelly Johnson. You don't have to be the smartest, the brightest in the room. Just keep it simple. I go ahead, I run my numbers for every single company. If I'm interested in it, I go ahead, run my numbers. It's the same process every single time. I don't complicate it. If they're growing, if I think they're going to grow a certain amount, I go ahead, slap a respectable PE. If I'm interested, great. Maybe I'll go ahead and buy it. If this is a bad number, bear case is horrible, not that great of upside, I don't go in. So it's the same process every time. Focus on the long term. What are you building 3, 5, 10 years into the future? I'm not buying a company if I don't think I want to hold it 2, 3 years into the future. I don't care what happens in a couple months. I don't care where the next 15, 20, 30% is in the company. I want to know where's the next 100, 200, 300% is in the future. So don't worry about FOMO, the hype, getting into options, predictions, hoping something will play out, the noise you see on the news. You know, what are they saying online? What are the analysts saying? Forget all that, the short term. Focus on the long term. These are your guardrails right here in green. You got a straight path. Go down that path and forget about everything else. So that's all I got for this video. I hope you learned something in this video. You can always go back if you didn't understand it, and I'll see you guys in the next one.